Hey everyone, this is Babar Honey, and tonight we're talking about something that might not be the hottest topic, but it absolutely should be. I'm talking about Bangladesh's foreign exchange reserve. Stick with me because it's a very important topic, because having a strong opinion about your country's economic future, it's pretty important. Now, before we dive into where we're currently at, let's talk about why it's important for you to know this. First of all, the foreign exchange reserve plays a crucial role in maintaining the stability of our country's currency, taka. When the taka starts losing value against foreign currencies, it's often due to trade deficits or political instability. The Bangladesh Bank steps in to prevent a rapid devaluation. Why is this important? A rapidly depreciating currency can lead to higher import costs, increased inflation, and a loss of purchasing power for all of us. In simpler terms, your daily cup of tea could start costing as much as a chai latte from North End. That's not my name. Secondly, Secondly, a significant portion of Bangladesh's foreign exchange reserve is used to pay for critical imports, goods and services that we can produce domestically in sufficient quantities. We're talking about energy, machinery, equipment, food, and essential commodities. If our reserves falls too low, the government might struggle to pay for these essentials, leading to shortages and skyrocketing prices. Imagine a world where we have to ration electricity or where cooking oil becomes a luxury item. Thirdly, our forex reserves are critical for paying off debt. Bangladesh has taken loans from international financial institutions like the World Bank and the International Monetary Fund. These loans are often in foreign currencies, typically US dollars. If we run out of foreign reserves, we might default on these debts. And defaulting isn't just a fancy financial term, it means we'd lose international credibility. And borrowing money in the future would become more expensive or even impossible. Now, let's look at what increases our reserves. Every time someone in New York buys a Made in Bangladesh t-shirt, a few dollars flow back into our economy. You see, our booming garment industry exports a lot of clothing to the US and Europe, and it brings in a significant amount of foreign currency. And then, you see, every time a Bangladeshi engineer sends back money from Dubai, it helps build a reserve. So, increased remittances. When a Bangladeshi expatriate working in countries like Saudi Arabia, the UAE, and Malaysia, they send billions of dollars back at home. Now let's look at what decreases our reserves. You see, if Bangladesh were to import more luxury cars than the amount of garments that's being exported, it's going to drain our reserve. So when our imports for petroleum, machinery, and food exceeds the value of our exports, it's going to have a negative effect on our reserves. And then there's debt payments, regular payments on foreign loans for infrastructure projects. It requires foreign currency. So paying off loans for the Padma Bridge, it ain't cheap. Now let's finally talk numbers. How much money do we actually have? First of all, you'll see that we have two figures here to look at. Foreign exchange reserves, gross, and foreign exchange reserves as per BPM6. Stick with me here. I'm going to make it simple. Gross reserves includes assets that aren't exactly easy to cash out. BPM6, on the other hand, tells us exactly how much money we can actually use in a pinch. Think of it as the difference between a big number that sounds impressive and the real number that actually matters for things like loans and, keeping the country financially afloat. So let's look at how our reserves have been doing over the year. Spoiler alert, it's not exactly a growth chart you'd want to frame and hang on your wall. Now, if you look closely, you'll notice that not only is there barely any growth, there's a noticeable dip starting in 2023. By the way, did you know that Adani's power bill, which we started paying from that year, it has been costing us about $100 million every single month? Yes, you heard that right. Every single month, $100 million. Anyway, we're going to move on to our current year's monthly figures. In June, our reserves hit 21.68 billion USD. But this was right when the anti-quota movement started gaining serious momentum. It led to massive protests, and, well, there was a dip in exports, it seems. But fortunately, we had remittances of around 2.53 billion, which gave us some breathing room during that tough period. Now, by July, the Hasina regime had fled, and Dr. Yunus stepped in, uncovering a pretty shocking level of corruption. And at that point, our reserves had dropped to 20.39 billion USD, and the countless protests didn't make things any easier. But again, Remittances came through, and we still managed 2.22 billion USD in July. These remittances played a huge role in maintaining some level of stability during an otherwise chaotic time. From there, the reserves took a steady decline. Now, as of September 18th, we're sitting at 19.4 billion USD, enough to cover about 4 months of imports. With garments exports taking a hit from all the slowdowns and protests, it's clear we're in a tight spot. The lack of law and order during this period, combined with the economic pressure, has really weighed on our ability to stabilize and grow. Now, what does all of this tell us? Well, the previous government didn't exactly prioritize developing new industries. We've got so much untapped potential that could help diversify our economy. Imagine if we harnessed our natural beauty and cultural heritage to boost tourism. Cox's Bazar could be the next Bali if we actually invested in it. Or what about tech? Imagine if we invested in tech education to become a regional hub, instead of just waiting for the next generation of garments workers or remittances to save us. So what's the takeaway here? Well, it's clear that our foreign reserves tells a much deeper story than just a balance sheet. It's a story of missed opportunities and over-reliance on only a few sectors. But the good news, the future is in our hands. We just need to start focusing on building new industries that can actually drive growth. Now, with that said, I apologize if this video felt like an economics class. And I think I was also shouting a bit, so sorry about that. But trust me, understanding this stuff is going to be crucial as I dive deeper into this topic in the coming days. It's important that we all know about it so we can engage in informed conversation and speak up for our country's future, economic future. Till next time.